There is a pattern that precedes every major regional real estate discovery cycle in American history. Wealthy early movers identify an overlooked geography with specific characteristics. Natural beauty that cannot be replicated. Geographic isolation that provides privacy at scale. Land availability that allows the kind of acquisition that is simply impossible in already discovered markets. They begin acquiring quietly, through entities that do not connect obviously to their public identities, in transactions that do not appear in the publications that track luxury real estate markets because they never reach the MLS. Infrastructure follows. A private airport expansion here. A new medical facility there. A high-end hospitality project that would not make financial sense in a market without a critical mass of high-net-worth residents, but makes perfect sense once that critical mass exists. Services and amenities developed to serve the presence of wealth that has already arrived. The area's identity shifts. And then the general market notices. By the time the general market notices, the entry point that existed at the beginning of the pattern is gone. It happened in Jackson Hole, Wyoming. In the 1950s, Jackson was a ranching town with a modest ski area and land prices that reflected its status as a remote, economically marginal community. The wealthy early movers who acquired significant land positions in that era, attracted by the Grand Teton scenery, the hunting, and the isolation, paid prices that look almost incomprehensible against today's valuations. Jackson Hole is now one of the most expensive real estate markets in the United States, with median home prices that exceed most major coastal cities. The Hamptons followed a similar sequence. Sun Valley, Idaho, followed it decades ago, which is why Sun Valley is now a known quantity with price levels that reflect its discovered status. The 7 Idaho towns in this breakdown are at a different point in that sequence. The wealthy early movers have arrived. The acquisition pattern is visible in the data. But the general market has not yet priced what the early acquisition activity implies. That gap between what the data shows and what the market has priced is the window that closes, eventually and permanently, in every discovery cycle that has preceded this one. What the county recorder data actually shows. I referenced the county recorder data as the source that makes the early acquisition pattern visible to anyone who knows what to look for. Before we get into the specific towns, I want to be precise about what that data contains and why it reveals something that standard real estate market analysis misses. The specific signal in the Idaho County Recorder data that is most significant is one that I will return to when we reach the town that represents the most advanced and most consequential example of this pattern. Hold that thread. Why Idaho? Why now? Why these 7 towns specifically? Understanding why ultra-high net worth capital is moving into specific Idaho markets requires understanding what that capital is optimizing for. Because it is not optimizing for the same variables that drive standard residential real estate investment decisions. The primary variable for significant family office and billionaire land acquisition is not near-term ROI. It is optionality preservation at scale. The ability to own a geographically significant position in a landscape that cannot be replicated. In a regulatory environment that respects property rights, in a jurisdiction with low tax burden, and at a distance sufficient from existing density to ensure that the character of the acquisition is protected over a multi-decade hold horizon. Idaho satisfies all of those criteria simultaneously in a way that very few states can match. No state income tax. Strong private property rights framework. A land and water legal system that protects senior water rights in ways that are increasingly valuable as water scarcity becomes a defining resource constraint across the American West. Geographic diversity that ranges from desert canyon country in the south to alpine lake environments in the north, with river valley agricultural land connecting them. And critically, a land market that has not yet been fully repriced to reflect the demand that is building from capital that has exhausted acquisition opportunity in already discovered adjacent markets like Wyoming and Montana. Here is something most people completely overlook about the billionaire land acquisition pattern in the Mountain West. The buyers who are accumulating Idaho positions right now are not primarily motivated by vacation home access or lifestyle enhancement, though those benefits are real. They are motivated by what land economists call positional scarcity. The recognition that specific geographic assets, scenic river frontage, mountain valley ranches, lake perimeter parcels, exist in finite and non-replicable supply, and that the demand for these assets from global ultra-high net worth capital is growing while the supply is structurally fixed. Positional scarcity assets do not follow normal supply-demand dynamics because the supply genuinely cannot increase to meet demand. The 7 towns on this list were identified through a combination of county assessor transaction data analysis, airport activity tracking at private aviation facilities, permit activity for high-value construction in rural counties, and the presence of specific infrastructure investments that correlate historically with early-stage wealthy buyer concentration in comparable markets. Not every town on this list is at the same stage of the discovery pattern. Some are earlier, with acquisition activity visible primarily in the land and ranch market rather than the residential market. Some are more advanced, with the infrastructure following already beginning to appear. And one is at a stage where the gap between current pricing and the implied forward valuation from the acquisition activity is most acute and most time-sensitive for buyers who are watching this right now. But before we get to that town, you need to understand the specific risk that this pattern creates for the existing residents and local buyers in these markets, because it is not the risk most people assume. And this is where most investors get caught. The risk that nobody is talking about. The conventional risk narrative around billionaire land acquisition in rural communities focuses on affordability displacement. Local residents priced out by wealthy buyers driving up land values. That risk is real and it is significant for the communities affected. But it is not the primary financial risk for the investor or buyer who is evaluating these markets from the outside. The primary financial risk for outside buyers entering these markets is what we can call the liquidity trap of discovery stage markets. And it operates differently from the liquidity traps of oversupplied urban markets that we examined in the context of Florida and Sun Belt cities. That assumption that getting in early is always the smart move? The liquidity math does not always support it. In a discovery stage market where the primary acquisition activity is occurring in the land and ranch segment rather than the standard residential segment, the resale market for residential properties can remain illiquid for an extended period even as the surrounding land is accumulating significant value. The wealthy buyers who are driving the acquisition pattern in these markets are buying land, not houses. Their presence does not immediately create a deep resale market for standard residential properties in the same communities. It creates the conditions for that market to eventually develop, on a timeline that is measured in years to decades rather than months. An outside investor who enters a discovery stage Idaho market expecting to realize appreciation on a residential property within a 2 to 3 year hold horizon may be correct in the directional assessment that the market is repricing upward while being incorrect about the timeline on which that repricing becomes liquid. The difference between being right directionally and being right on timing in an illiquid market is the difference between a successful investment and capital tied up in an asset that cannot be converted back to cash at the expected price within the expected period. This is the loop I opened earlier about what the county recorder data actually shows and why it matters for this specific risk. The data does not only show who is buying. It shows what they are buying, how they are holding it, and how long comparable acquisitions in the same corridors have been held before any resale activity occurred. In the most advanced of the 7 markets on this list, the holding period data for early institutional and high net worth acquisitions suggests that the patient capital entering these markets is underwriting holds of 10 years or longer. That is the timeline on which the repricing these buyers are anticipating is expected to materialize. Individual investors with a shorter liquidity requirement than that need to size their positions accordingly. Binge bridge. The risk is real and it is manageable with the right position sizing and hold period discipline. Now let us get into the specific towns, because the opportunity and the risk are not distributed equally across all 7. And the differences matter enormously for how you evaluate each one. Town number 7, Salmon, Lemhi County, the River Valley frontier. Salmon sits in the Salmon River Valley in central Idaho, surrounded by the Frank Church River of No Return Wilderness, the largest contiguous wilderness area in the continental United States outside of Alaska. The geographic isolation that defines Salmon is not a bug in the investment thesis. It is the feature. The town sits at the end of a significant drive from any major population center, and that inaccessibility is precisely what has preserved the landscape character and land availability that early wealthy buyers in comparable Mountain West markets paid a premium to access. Significant ranch acquisitions in Lemhi County in recent years have involved buyers whose names and associated entities do not appear in local media but whose transaction footprint is visible in the county recorder data. The Salmon River Corridor has attracted conservation-minded wealthy buyers who are acquiring ranches not for development but for preservation, using conservation easement structures that lock out future development while generating federal tax benefits. The concentration of conservation easements in a corridor is historically one of the most reliable leading indicators of wealthy buyer presence in rural Western markets. Here is what most miss. Conservation easements are not just tax tools. They are signals. They show you where sophisticated long-term capital has decided the landscape is worth protecting permanently. For a standard residential buyer or small investor, salmon represents the earliest and most frontier stage of the pattern we are tracking. This is what I was referring to earlier when I described the spillover mechanism that precedes discovery cycles in adjacent markets. The buyers coming into Driggs and Teton Valley are not discovering Idaho. They are being priced out of Wyoming and finding that the landscape they were paying for in Wyoming exists on the Idaho side of the mountains at a different price point. That is not a speculative demand driver. It is an arbitrage that is being actively executed by buyers with the financial capacity to act on it. Driggs is further along in the pattern than salmon. The Driggs-Reed Memorial Airport has seen private aviation traffic increase substantially. High-end hospitality and retail development consistent with an affluent seasonal resident population has appeared in the town center. And land prices in the valley have been rising at a pace that outpaces the broader Idaho market, reflecting the compression of the premium gap between Teton Valley and Jackson Hole that drives the spillover demand. Town number 5. McCall, Valley County. The Lake Market Maturation. McCall sits on the southern shore of Payette Lake in Valley County and represents the Idaho mountain lake market that most closely parallels the established resort lake markets of the Mountain West. The town has been a recreation destination for Boise area residents for decades, which means it has a longer history of second home ownership and seasonal population than the more frontier markets on this list. That history creates both an advantage and a complication for investors evaluating it now. The advantage is infrastructure maturity. McCall has the services, the airport with regular private aviation access, the healthcare facility, the hospitality options, and the established community character that newer discovery markets are still developing. The complication is that the market is further along in its repricing, meaning the early mover premium that exists in salmon or Riggins has been partially but not fully captured. The billionaire acquisition activity in the McCall corridor has been concentrated in the lake frontage and large parcel mountain properties outside town rather than in the town's residential market directly. Several significant transactions involving entities associated with technology sector wealth have occurred in Valley County in recent years, acquiring properties that provide both the lake access and the privacy at scale that the ultra-high net worth buyer profile requires. These acquisitions are not driving the residential market directly today, but they are establishing the wealth presence that historically precedes the infrastructure investment that reprices the surrounding residential market. Town number 4, Riggins, Idaho County. The river access play. Riggins is positioned at the confluence of the Salmon and Little Salmon rivers in a canyon landscape that offers some of the most dramatic river scenery in the American West. The town is small enough that it does not register in most regional real estate analyses, and that invisibility is central to the opportunity it represents in the current cycle. The specific acquisition pattern in the Riggins corridor involves buyers seeking river access, fishing rights, and canyon privacy in a market where the land prices have not yet reflected the demand that comparable river access commands in more established Western markets. The Salmon River below Riggins contains significant stretches of prime whitewater and fishing access that are limited by private ownership of adjacent land, creating a positional scarcity dynamic similar to what we identified as the primary motivation for early-stage billionaire land acquisition across the Mountain West. Pause. River access rights in the American West are not just recreational assets. They are water rights. And water rights are among the most strategically valuable assets in Western land markets right now. The water rights dimension of Riggins area land acquisitions is worth specific attention because it adds a layer of forward value that standard residential real estate analysis does not capture. Senior water rights on Western river systems, established under prior appropriation law, represent claims on a resource whose scarcity value is increasing as Western water availability becomes a more acute constraint on population growth, agricultural production, and economic development. Buyers who understand this dimension of Western land acquisition are evaluating Riggins area properties not only on their scenic and recreational value but on the water rights position that comes with senior riverfront ownership. Town number 3, Sandpoint, Bonner County. The most advanced discovery stage. Sandpoint sits on the northern tip of Lake Pend Oreille, the largest lake in Idaho and one of the deepest in the United States. The town has been building its reputation as a mountain lake destination for longer than most of the other markets on this list, and its current stage of the discovery pattern is the most advanced short of fully repriced resort market status. The billionaire acquisition activity around Sandpoint is the most publicly documented of the 7 towns on this list, though it is still significantly underreported relative to its actual scale. Several prominent technology executives and investors have acquired significant properties in the Lake Pend Oreille and surrounding mountain corridor. The private aviation infrastructure at Sandpoint Airport has been upgraded. High-end residential development consistent with an established wealthy buyer presence has appeared on lake frontage. And the Schweitzer Mountain Resort adjacent to the town has attracted investment and development consistent with a market moving up the resort status ladder. Here is the critical distinction between Sandpoint and the earlier stage markets on this list. Sandpoint's repricing is further along, which means the entry point advantage is smaller, but the liquidity is materially better. A buyer entering Sandpoint today is not accessing the same early mover discount that exists in Salmon or Riggins. But they are buying into a market where the resale buyer pool is deeper, the hold period required to realize appreciation is shorter, and the infrastructure supporting the wealthy buyer presence is more established. The risk-return trade-off is different, not better or worse, but different in ways that need to match your specific investment objectives and liquidity requirements. Town number 2, Stanley, Custer County. The most dramatic landscape premium. Stanley is one of the most geographically remarkable small towns in the United States. Located in the Sawtooth Valley at the base of the Sawtooth Mountain Range, with the Salmon River headwaters running through it and the Sawtooth National Recreation Area surrounding it on multiple sides, Stanley offers a landscape intensity that is genuinely rare even within the Mountain West's exceptional portfolio of scenic environments. The town itself has a tiny permanent population, which creates an interesting dynamic for property acquisition. The number of properties that can exist within a reasonable proximity to Stanley's core landscape assets is structurally limited by the surrounding federal land ownership that defines the Sawtooth NRA. That federal land constraint is a supply restriction that functions similarly to the ocean or lake frontage limitations in established premium markets. You cannot develop around it or through it. The properties that exist within the valley have a supply ceiling that is enforced by federal land ownership rather than by regulation, which makes it more durable and more absolute. Sun Valley's core resort market has been established for decades. But the Wood River Valley that extends south from Sun Valley through Ketchum and into the Blaine County landscape beyond represents a geography that is being systematically acquired at a pace and by a buyer profile that has direct historical parallels in the pre-discovery phase of markets that subsequently repriced dramatically. This is what I was building toward from the very beginning of this breakdown when I said the county recorder data reveals something that standard real estate market analysis misses. In Blaine County, the recorder data shows a pattern of large parcel acquisitions by entities that in several documented cases trace to family offices and wealth management structures associated with some of the most significant capital concentrations in the United States. These are not vacation home buyers. They are strategic land accumulators whose acquisition behavior in comparable markets has historically preceded significant infrastructure investment and the repricing that follows infrastructure. The scale of what is being assembled in the Wood River Valley, quietly and without public announcement, is the most significant signal in Idaho's current real estate market. The infrastructure following the capital in the Wood River Valley is already visible. The Friedman Memorial Airport serving the Sun Valley area has been progressively upgraded to accommodate larger and more sophisticated private aviation traffic. Healthcare infrastructure consistent with a permanent high-net-worth residential population rather than a seasonal resort community has expanded. And the commercial and hospitality development in Ketchum itself has been moving upmarket in ways that reflect the spending capacity of the buyer profile that has been accumulating surrounding land positions. The distinction between Ketchum and Sun Valley's established resort core is important for the investor evaluating entry points. Sun Valley itself is fully repriced. The entry point advantage is gone for a buyer seeking to participate in the discovery pattern rather than pay the post-discovery premium. Ketchum and the broader Wood River Valley represent the geography where the pattern is most advanced, while the pricing gap relative to the implied forward valuation from the acquisition activity remains most significant. The strategic framework: how to position in Idaho's discovery markets. The 7 towns on this list represent a spectrum from early frontier stage to advanced discovery stage. The appropriate positioning strategy is different for each stage, and applying the wrong strategy to the wrong stage is the most common error outside investors make when entering discovery stage rural markets. For the early stage markets, salmon and riggins specifically, the appropriate position for an outside investor is a small allocation with maximum patience. The directional thesis is sound. The timeline is long and uncertain. Position sizing should reflect the genuine illiquidity of these markets and the extended hold period that realizing the implied appreciation requires. These are not positions for capital that has a defined liquidity requirement within 5 years. For the mid-stage markets, Driggs, McCall, and Stanley, the liquidity profile is somewhat better but still requires a disciplined hold period and honest sizing relative to overall portfolio liquidity. These markets have enough transaction activity to establish more reliable pricing and to provide periodic exit opportunities, but they are not markets where a distressed sale can be executed without significant price concession. The appropriate allocation is one that can be held for a minimum of 5 to 7 years without creating portfolio-level liquidity pressure. Here is the framework question that every investor evaluating any of these 7 markets must answer honestly before committing capital. If you needed to convert this position to cash in 18 months at whatever price the market would bear, what would the financial consequence be? If that consequence is one you can absorb without meaningful damage to your broader financial position, the investment is appropriately sized. If it is not, it is not. The discovery stage Idaho market opportunity is real. The illiquidity is equally real. Positions sized for illiquid markets that are subsequently subjected to liquid market timing pressures are where the losses in these opportunities are realized. For the advanced stage markets, Sandpoint and Ketchum specifically, the entry point advantage is smaller but the liquidity and hold period requirements are more consistent with standard investment discipline. These markets have the transaction depth, the infrastructure maturity, and the established wealthy buyer presence to support more conventional investment underwriting. The risk is paying a premium that has already absorbed a significant portion of the discovery repricing, leaving a smaller remaining upside against a carrying cost structure that reflects the market's more advanced status. The closing. What the pattern is telling you right now. The Jackson Hole discovery cycle played out over several decades. The buyers who participated in its earliest stages did not know they were participating in what would become one of the most dramatic regional real estate appreciation stories in American history. Simply identifying a geography with specific characteristics and moving capital into it before the general market had arrived at the same conclusion. The 7 Idaho towns in this breakdown are at varying points in a pattern that has the same structural characteristics as every preceding Mountain West discovery cycle. The geography is genuinely exceptional. The supply constraints are real and durable. The wealthy capital that historically precedes general market discovery is visibly present in the county recorder data. And the general market has not yet priced what the early acquisition activity implies. This is where things shift. The pattern does not wait for the general market to catch up before it completes. The window that exists in these 7 markets is not permanent. It will close on a timeline determined by the pace of infrastructure development, the visibility of the wealthy buyer presence, and the eventual coverage that transforms local obscurity into national narrative. That timeline is uncertain. But the direction of travel is not. The investors who will look back on the current moment in Idaho's discovery markets as a missed opportunity will not have lacked access to the information. The county recorder data is public. The airport activity is trackable. The infrastructure investment pattern is observable. What they will have lacked is the discipline to take the pattern recognition framework seriously before the narrative that confirms it has been written. Here is the final convergence of everything this breakdown has established. The wealthiest capital in the world does not announce its intentions. It moves quietly, through entities that do not connect obviously to its source, into markets that appear obscure until they do not. The 7 Idaho towns on this list are in that pre-announcement phase right now. The acquisition activity is visible to anyone looking carefully at the right data. The general market repricing that historically follows this phase of the pattern has not yet occurred. That gap is the opportunity. How much of it remains when you are watching this, and whether you act before or after the narrative catches up to the data, is the only variable that determines which side of the historical pattern you end up on.